Hello, good afternoon. My name is Erickson, student of Bachelor of Science in Business Administration, major in Financial Management, and I'm here today to discuss the following topics. Number one, identify the purpose of financial markets and financial institutions. Number two, find monetary policy. Number three, explain the role and the workings of central banks in our economy. Excuse me. And then number four, explain the importance of a strong financial market in every developing economy and enduring negative crisis. So to start off, purposes of financial markets. Number one, facilitating capital allocation. Financial markets connect those who have surplus funds, the investors, with those who need the funds, the borrowers, ensuring efficient allocation of resources. Example is stock in quantities. Number two, price discovery. They will determine the fair prices of financial assets through supply and dynamics, helping investors make informed decisions. Number three, liquidity provision. Financial markets provide liquidity, enabling investors to buy or sell assets easily and convert them into cash when needed. Number four, risk management. Through instruments like derivatives and diversification, financial markets allow participants to manage risk associated investments or financial techniques. So, five, economic indicators. Financial markets reflect the health of an economy. Movements in markets given signal trends like economic growth. Purpose of financial institutions. For one, intermediary role. Financial institutions act as intermediaries between savers and givers, making the flow of funds efficient and safe. Example of banks, credit unions, and investment firms. Number two, safeguarding savings. They provide secure places for individuals and businesses to deposit their money while earning interest. Providing credit. Number two, financial institutions provide loans and credit, enabling businesses to expand and limit individuals to make significant purchases. Example, home loan or an online. Number four, facilitating payments. They support payment systems including checking accounts, electronic transfers, and credit card services, making transactions convenient and efficient. Number five, risk mitigation. Institutions like insurance companies help manage financial risk by providing coverage for potential risks. Number six, economic stability. They contribute to economic stability by implementing monetary policy because it provides providing predictable returns and ensuring flow of funds remains smooth. Together, financial markets and institutions create a robust system to support economic activity, foster growth, and ensure stability by channeling the funds where they have most need. Definitions of monetary policy. There are two types of monetary policy. Expansion number one is expansion of monetary policy. This type of policy is being implemented to economic slowdowns or recessions. Purposes to increase the money supply and lower interest rates to encourage borrowing and spending. Number three, contractionary monetary policy. This is used to combat high inflation. People decrease the money supply and increase interest rates to reduce spending and borrowing. Role and importance of central banks in our economy. Central banks are digital institutions responsible for managing the financial system, ensuring financial stability and fostering economic growth, and they perform several critical functions. Number one is monetary policy and regulation. Central banks control money supply and interest rates to stabilize inflation, encourage employment, and support economic growth. Examples adjusting interest rate and influence borrowing and spending. Number two, issuing currency. They have the sole authority to issue the national currency, maintaining trust in the banking system. Example, the stone payment and managing physical. Number three, lender of last resort. Central banks provide emergency funding to financial institutions, facing liquidity crisis, preventing systemic collapse. Examples providing liquidity to banks during financial crisis. Before, maintaining financial stability. By regulating and supervising financial institutions, they ensure banks and technology security. Example is setting capital requirements and protocols. Number five, managing foreign exchange reserves. Central banks manages currency exchange rates and foreign exchange reserves to stabilize investment. So, example is intervening in foreign markets to prevent currency volatility. Number six, conducting open market operations or open. They buy and sell government securities to regulate liquidity in the economy. Example, the selling points to reduce money supply during inflation. Number seven, formulating banking regulations. Central banks set rules for economic for commercial banks to ensure soundness of banking sector. Example is implementing reserve requirements or stress testing. So now we go to the importance of central banks in the economy. Number one is economic stability. Central banks help stabilize the economy by controlling inflation, managing unemployment, and fostering sustainable growth. Number two, confidence in financial system. Their regulation and oversight ensuring trust in banks and financial institutions teaches larger providing good performance. Inflation control. By keeping inflation at moderate levels, central banks preserve the purchasing power of the money to ensure and community certainty. In report, crisis management of the union. They play a crucial role during financial crisis concern, liquidity, and preventing systemic problems. Number five, support for government policies. Central banks government fiscal policies like consumer debt, financing deficits, and ensuring fiscal stability. Importance of central banks in the economy. Um, this is actually number six. Global economic integration. Central banks interact with international counterparts to manage global financial crisis and coordinate economic policies. These are examples of central banks in different countries. Federal Reserve is also European Central Bank, ECB, Bank of England, Reserve Bank of Union, People's Bank of China. So central banks act as a guard for nations' economy, ensuring stability, growth, and trust in the financial systems. Their actions directly impact every aspect of economic life, from consumer spending to international travel. And so now we go to the importance of strong financial market in every economy and ensuring economic growth, which is the last topic of this discussion. So, a robust financial market plays a critical role in helping an economy navigate and recover from economic crisis. And there are reasons why. There are two. Number one is efficient allocation of resources. Strong financial markets facilitate the efficient allocation of capital sectors and businesses that need most even during crisis. Example is it ensuring that financially sound businesses with access to credit to sustain operations during downturns. Um, Number two, providing liquidity. Well-functioning financial methods provide liquidity and businesses. businesses and individuals to convert assets into cash. Yeah. So, white matters. Liquidity prevents panic and it enables continued economic activity during financial instability. And that's the last slide of this discussion. And that concludes my